All right, let's jump right into this explainer, because right now, we are unpacking a truly historic and honestly kind of contradictory moment in the global economy. Today, we're going to break down this massive transition we're seeing where artificial intelligence is officially moving from sheer capital expenditure into actual revenue generation. But at the exact same time, we've got to decipher these incredibly mixed signals we're getting, namely a noticeably cooling consumer base right alongside a literally record-breaking stock market. So what does this all mean for us?
We've got a packed agenda today. We'll funnel down from broad market highs into some massive landscape-shifting AI deals. From there, we'll look at specific stock movers, examine the macro consumer weakness, and finally take a really deep dive into some confusing macro labor data that we're calling the jobless boom.
First up, Section 1, Record Highs Amid Relief.
So kicking things off with the broad market picture, we recently got some pretty benign CPI and PPI reports, and that significantly eased rate hike fears. It actually provided a massive relief rally across the major indices. Just look at the S&P 500. It reacted by closing at a record near 7,800 on August 13th. That finished the index up over 4% for the entire month. But it wasn't just the large caps. We saw fresh record highs for the Russell 2000 too, with the Nasdaq and Dow posting modest gains. Though, it is worth noting, while equities are out there celebrating, the bond market is showing just a tiny bit of caution. The recent 30-year Treasury auction saw its highest yield since 2001. So long-term inflation concerns? Yeah, they haven't completely vanished just yet.
Moving on to Section 2, AI enters its monetization phase.
Now, this brings us to the absolutely biggest fundamental shift happening in the market right now. AI infrastructure is officially monetizing. We are finally moving past the hype phase and straight into the revenue phase. And to really grasp the scale of this, just consider this one fact. Nvidia recently announced a staggering $500 billion financing partnership to fund AI data center buildouts. $500 billion. This is an absolute watershed moment because it effectively cements compute power as more than just a piece of technology. It's now a legitimate institutional asset class.
And what's really fascinating here is the sheer institutional firepower backing this deal. Just listen to these heavy hitters. We're talking BlackRock, Apollo, Blackstone, Brookfield, Goldman Sachs, and KKR. The fact that the absolute biggest names on Wall Street are stepping in to finance these data centers completely validates this trillion-dollar AI buildout. They aren't just betting on some future tech anymore, you know? They're seeing the actual current cash flows.
Tech analyst Dan Ives hit the nail on the head with this exact sentiment. He points out that hyperscalers, the massive cloud providers, and neoclouds are officially validating their massive capital expenditures because they're seeing actual enterprise revenue growth on the other side. AI is no longer just a massive cost center, folks. It's becoming a profit engine. And the demand side of the equation, it is just as concrete. I mean, we're seeing monumental numbers across the board. CoreWeave stocks surged 19% after they reported an incredible $104 billion backlog, plus over $25 billion in new customer commitments. Supermicro jumped 9% post-earnings on a $60 billion backlog, and they raised their Q1 guidance well above estimates. We even saw Riot Platforms lock in a $9.1 billion 22-year deal with Anthropic for computing power down in Texas. The demand is absolutely real, and it is accelerating fast.
Let's look at Section 3, Sector and Stock Movers.
Under the hood of those index records we talked about, the tape is actually highly selective. The crucial point to understand right now is the massive divergence we're seeing. On the gainer side, massive acquisition premiums. MarineMax jumped 46% on a $1.5 billion acquisition by Blackstone Infrastructure. SanDisk rallied nearly 14% on a super aggressive financial model targeting 75% plus operating margins. But then, on the flip side, Cisco dropped over 8% on a disappointing data center sales outlook, even despite an earnings beat. And Hertz? They plunged 16% as Pershing Square entirely dumped its stake, citing a total loss of confidence in management. Comparing two of these heavyweights perfectly contrast our current market dynamics. Workday surged 30% intraday on Silver Lake buyout talks. That completely dispels those recent SaaS apocalypse fears and proves the immense value of enterprise software in this AI era. But looking at the consumer side, we have Apple slipping 1.6% following a Jefferies downgrade that specifically cited iPhone affordability concerns. And that perfectly sets up our next topic, the sheer resilience of enterprise spending versus the emerging, very real cracks in consumer spending power.
Which brings us to Section 4, Consumer Weakness and Retail.
So, zooming out to the broader economic data, the everyday consumer is definitely feeling the pinch. It paints a much more cautious picture than the enterprise AI boom we just looked at. July retail sales dropped 0.6% overall against expectations of a slight gain. That's actually the largest decline in over a year. It was heavily dragged down by autos, dropping 1.8%, and non-store retailers, dropping 2.2%. But a quick caveat, context is absolutely vital here. That non-store drop was likely skewed a bit by Amazon Prime Day shifting to June this year. And if you strip out autos and gas, the control group sales actually did show some resilience in categories like clothing and personal care.
Still, compounding that retail drop, the University of Michigan consumer sentiment plummeted to 51. It missed expectations of 55 and hit its weakest level since June. Ouch. This number reflects deep, persistent consumer concerns over inflation and, frankly, their shrinking wallet share.
Section 5. The Jobless Boom Paradox. Okay, this brings us to a fascinating macro paradox that has the Federal Reserve incredibly stressed out ahead of their Jackson Hole symposium. Let's dive into this concept of the jobless boom. The Wall Street Journal's Greg Ipe recently highlighted this dynamic, and it is absolutely essential to understand right now. It's basically an environment where gross domestic product and corporate earnings remain remarkably robust, but job growth completely stalls out. Why? Well, because AI adoption is boosting productivity without the need for proportional hiring. We are effectively watching economic output completely decouple from human labor.
The friction in the system is really clear right now. On one hand, the economy is humming at the top line with those strong earnings we just discussed. But on the exact same token, hiring rates are hovering at roughly 50% of what they were pre-pandemic. July actually marked the 5th decline in job growth in just the last 12 months. Plus, wage growth is just kind of stuck at a tepid 3.2% year over year.
So, strong growth and sticky inflation paired with a weakening labor market, that means the Fed is strapped in a serious dilemma. A few weeks ago, the market was totally complacent, fully expecting rate cuts. Now, expectations have completely shifted, pricing in around a 30% chance of a September rate hike. The central bank has to somehow figure out how to cool asset exuberance without accidentally tipping this fragile labor market into a full-blown recession. Finally, Section 6, Key Takeaways for Investors. So how on earth do we trade this environment where microtech is booming, but the macro consumer is bleeding? Let's distill all of this into some actionable insights. Here are your 5 key takeaways. Number 1, AI is no longer just Capex, it's generating real, tangible revenue. 2, while the consumer is soft, don't panic entirely. Timing skews like Prime Day and gas prices mean this might just be transitory. 3, watch the Fed closely as they try to navigate this massive jobless boom dilemma. 4, and this is absolutely crucial for investors, watch the optical components and CPU sectors. Companies like Lam Research, KLA, ARM, and AMD are emerging as the next wave of infrastructure bottlenecks, and that is exactly where the alpha might be hiding. And finally, number 5, keep a very close eye on circular financing.
Actually, I want to leave you with this final provocative thought to chew on regarding that circular financing. Nvidia's massive $500 billion deal absolutely validates the AI thesis today. But some macro strategists are drawing some pretty scary parallels to subprime-era financialization. Does this kind of circular financing pose a massive risk? Are we using artificial demand to mask oversupply, or are these end users truly buying for sustainable, internal enterprise needs? Look, as long as GPU utilization remains high, the bubble risk is mitigated. But if end-user adoption ever slows down, the ripple effects will be historic. Keep an eye on those data center utilization rates. Thanks for joining this explainer, and I'll catch you next time.